Welcome, friends. Let me introduce myself. I am Dr. Chandika Prasad, Assistant Professor, Department of Commerce, Parampur University. Friends, today I will discuss the fundamentals of derivative. Derivative is a financial instrument which value derived from its underlying asset. The value may be derived from the value of one or more variables related to underlying asset. Let us say you want to purchase a derivative of Reliance share. Then in that case, the underlying asset would be the market price of Reliance share. It has no independent value. The value of a derivative contract is dependent on another asset. Hence, derivative is not an asset. Derivative is a contract. The underlying assets are the financial assets based on which the derivative prices are fixed. You can take example of commodity derivative. Like petrol is a commodity whose underlying asset is crude oil. Gold, whose underlying asset is gold itself. So whenever an individual buys an instrument whose value depends on another asset is known as underlying asset for that instrument. There are different types of underlying assets. Financial underlying assets are equities, debentures, bonds, currencies, taxes. Agricultural underlying assets are grains, coffee, pulses, cotton. The precious metals like gold, silver, copper, aluminium. The energy sources such as crude oil, natural gas, electricity, coal, and interest rate. So these are different forms of underlying asset. Talking about the features, derivative, we know it is a contract between two parties which will be carried out in a future. The value of a derivative contract will be derived from its underlying asset or from its benchmark. The derivatives can be traded directly between the two parties or through exchange market or through stock exchange, that is National Stock Exchange. All the derivative transactions take place in a future specific date, and we called derivative is a risk hedging instrument, risk hedging contract. It reduces the market risk, it reduces the price fluctuation risk. There are four kinds of participants available in the derivative market. First is speculator. They are always ready to take the risk, and so they will get more return. Whenever you will take more risk, there is a chance of more return. If a company is having more beta value, means there is a chance of high return, less high risk. The second form of participants are hedgers. The hedgers are the risk averse. They usually enter into the derivative market in order to secure their investment portfolio against market risk and fluctuations. They don't want to take risk, they just want to cover up their portfolio. The third kind of participants are margin traders. Margin means the minimum amount that both the traders need to deposit with their brokers in order to participate in the derivative market. The fourth form of participants are arbitrators. The arbitrators usually buy low priced securities simultaneously in one market and sell them at a higher price in another market. In India, you cannot buy first in one market and sell in another market. You can sell first and then buy. But in Chicago Stock Exchange, in New York Stock Exchange, this arbitrage facility is available. The very purpose of derivatives are to earn profit by speculating the market fluctuations, the price fluctuations. The derivatives are having arbitrage opportunity where you can purchase at a lower price and sell them at a higher price in another market. Due to the derivative, the investors can get access to unavailable markets or assets. For example, interest rate swap, it is a form of derivative contract. So in India, we have fixed rate as well as fluctuate or variable interest rate being provided by the banks. So if you want to exchange your interest rate with another form of interest rate like fixed to floating or floating to fixed, then it can be done. You can get advantage of price fluctuations, and by doing so you can book more and more. Usually very few contracts are exercised in derivative. Many investors are entering into the derivative contract in order to book some profits, in order to take advantage of price fluctuations, but very few contracts are exercised on the day of. There are 4 types of derivatives contracts are available in India. These are forward contracts, option contracts, and swap contracts. Let us understand the concept behind forward contracts. Forward contract is an agreement between two parties which will be carried out at a predetermined price at a fixed date in the future. They are highly customized contracts. What can be customized? The price, size, the date be customized. So it has a high tendency of counterparty risk. If one party fails to execute the contract, then the counterparty risk will arise. Forward contracts not require any kind of collateral because they are self-regulated. The buyer and seller will form the rules and regulations and they will make an agreement between. This is an example of forward contract where the farmer is agreed to sell 500 kgs of wheat at rupees 40 per kg after 3 months to the bread maker, and 3 months later the farmer delivers 500 kgs wheat to the bread maker, and the bread maker honors the delivery and compensate the farmer with rupees 20,000. What are the risks lying in forward contracts? In forward contracts, both the buyer and seller are having credit risk. Means, does the other party have the means to pay? If the buyer denies to pay on the day of delivery, then the credit risk will arise. Talking about the operational risk, will the other party make delivery? Will the farmer make delivery on the delivery date? Or if the farmer is ready to take delivery, will the other party, like buyer, accept delivery? This is concept of operational risk. Talking about the liquidity risk, if either one of the party wants to opt out from the contract, then how to find out another counter is known as liquidity risk. And some of the terms used in forward contracts are long position, short position. Long, usually the party who is ready to buy the asset, they take long position, and the party who is ready to sell, they take short positions in the forward. The price prevailing in the market, known as market price or spot price, and the price of the asset at the delivery date is known as delivery price or forward price. The second form of derivative contracts are future contracts. The future is a standardized form of forward contract. What are the form of standardization? And the quantity, the quality, the delivery dates, the prices, these are standardized. It means it cannot be altered, it cannot be changed. And it is traded on the organized stock exchange like national stock. In forward contract, these are self-regulated contracts. It will be traded on over the counter. But in future contract, it will be traded in an organized exchange. Some of the terms used in future contracts are the contract size, means the amount of the asset that has to be delivered under one contract. Example, if the lot size of Tata Steel is 500 shares, then one future contract is necessarily consisting of 500 shares. The period for which contract trades is known as contract cycle. Futures on National Stock Exchange have 1 month, 2 months, and 3 months expiry cycle. The expiry date, usually the last Thursday of every month, or if the last Thursday is a public holiday, then the previous day of the Thursday is known as expiry. The strike price, this is the agreed price, this is the contract price. Buyer and seller agreed price is known as strike price. Cost of carry, this is the difference between strike price and current price. In future contract, both the parties have to deposit an amount with the clearing house before opening or entering into a futures contract. The aim or the very purpose of margin amount is to minimize the risk of default by either counterparty. In forward contract, if one party defaults or denies to execute the contract, then another party has to suffer loss. But here, to omit that loss, we have some collateral. If either one party fails to execute the contract, then the loss amount of another party will be met out of the margin account balance. We have initial margin, maintenance margin, variation margin, and margin call. Usually, both the traders who must deposit before starting the contract is known as initial margin. Usually 10% of the contract size is known as initial margin. If the total contract size is 500 kg and per kg price is in, then total contract price is 5,000. So 10% of 5,000, that is 500, will be the initial margin. Talking about the maintenance margin, both the parties have to maintain a minimum maintenance level of balance. If the balance goes beyond that limit, then the trader or buyer or seller, they are required to bring the margin back to its initial level. Usually, the maintenance margin is generally about 75% of the initial margin. Previous example, if the initial margin is 500, then the maintenance margin will be 500 into 75%, that is 375. And if the margin account balance goes beyond 375, let us say 350, then parties have to deposit up to the initial level. It means earlier the initial level is 500. So now the maintenance margin is 375, but now the margin balance is 350. So we have to deposit up to 500. It means 500 minus 350. That is one. So that is known as variation margin. The additional margin amount required to bring an account up to the required level. And at that time, one call will take place that is known as margin call. When the amount of margin account falls below the maintenance level, that margin call is made to fill the gap. And this concept is known as mark to market. Means in futures contract, there is a practice of periodically adjusting the margin account balance by adding or subtracting funds based on the changes in market value to reflect the investor's profit or loss. The mark-to-market concept leads to changes in margin amounts on daily basis, so that it will ensure that there is no defaults by the parties. The parties will gain something, both the parties will share some loss. If you compare the forward and future contract, then you can find the future contract are traded on organized stock exchanges like National Stock Exchange. They are highly standardized contract. The contract size, contract price, contract date cannot be changed. That is a clearing house. We need to deposit margin with our clearing houses. The market is very transparent. The mark to market basis concept is there, and mostly the future contracts are closed prior to delivery. Very often the contracts are executed on the delivery date, but investors enter into the future contract in order to get advantage of price fluctuations and market risk. And in future contracts, profits and losses are realized daily basis. Third form of derivative contracts is option contract. This is very different than future and forward contract because there is no compulsion to execute the contract on the specific date. When we are talking about option, it means the buyer will purchase only the right. And for that, the buyer has to pay some amount to the seller that is known as premium, option premium. So here, the buyer is purchasing the right, but not the commitment. I have the option. I may execute, I may not. This right lies with the buyer only. But the seller has to honor that obligation. The seller has to commit. If the buyer is willing to execute, the seller cannot deny because the buyer has purchased the right from the seller. So we have two options, call option and put option. In call option, the buyer has the right to purchase an underlying asset at a fixed price while entering the contract, but not an obligation. Let's say an investor buys a call option, right to purchase, but not an obligation. If the strike price is 35 and on the day of delivery, the market price is 30. It means in market, the price is 30. If an investor purchases from the market, then he has to pay 30 rupees. But in the contract, if I will execute the contract, then the price is 35. That is the strike price. So as the buyer is having the right, the buyer will not execute the contract. Rather, the buyer will pay the premium amount only and purchase it from the market itself. In put option, the seller has the right, but not an obligation. If the seller do not find favorable situation in the market, if the contract price is 35, but in market, the price is prevailing at 40, so the seller can sell in the market. Why to execute the contracts? In that case, the seller's loss will be the premium only. So investors can take any of the four different positions, short or long position, either in the call or put option. These option contracts are either traded at the stock exchange and over the counter market. This is an example of call option. Here, the option premium is 25%. Call option means right to buy 100 Reliance shares at a price of rupees 300 per share after 3 months. Rupees 300 will be your strike price. After 3 months will be your delivery date or expiry date. And your current market price is 250. So to purchase 100 Reliance shares, you have to pay premium of rupees 25 per share, and for 100 shares, that is 100 into 25, that is 2500. Let us say after a month, the market price is 400, and you exercised the contract. Then what will be your net gain? You have already agreed to purchase at 300, but the market is at 400. It means you will have a benefit of 100 rupees. So if you are purchasing from the market, you have to pay 40,000. If you will purchase through this contract, then you have to pay 30,000. So your profit will be 10,000. And you have already paid premium of rupees 2,500. Then your net gain will be 10,000 minus 2,500, that is 7,000. But suppose after a month, the market price is 200. Then will you exercise the contract? The market price is below than the strike price. You will not execute the contract. In that case, your loss will be limited up to the premium amount paid, that is 2,500. Let us understand the same example for put option. Let us say for put option, right to sell 100 Reliance shares at a price of 300 per share after 3 months. Suppose after a month, the market price is 200 and the option is exercised. Means if you will sell in the market, the price is 200. If you will execute the contract, then the price will be 300. Then what will be your net gain? 100 rupees into 100 shares, that is 10,000. And what you have paid? You have paid the option premium, that is 2,500. So your gain will be 7,500. But if the market price is 300 and you have not exercised the contract, then your net loss will be the premium amount, that is. These are the some terms used in option contracts. Underlying means the asset or instrument, the option premium, the price paid to purchase that right. Strike price, it is the pre-decided price between the buyer and seller. Expiration date, the date on which option contract expires. Exercise date, when the option is being exercised. The open interest, total number of option contracts outstanding in the market. It means that have not yet been expired, known as open interest. Option holder, the fellow who buys the option. Option writer, this is the seller, the fellow who sells the option. The fourth form of derivative contracts is swap contract. Swap means exchange. It is an agreement being done privately between both the parties. Here, you will not exchange asset. What you will exchange? You agree to exchange the cash flow in the future dates. Basically, the underlying security in swap contracts are the interest rate swap or currency swap. The swap contracts are traded on the investment banker basis. Here, the investor banker plays the role of middleman between these contracts. As I have already said, there are two types of swaps: plain vanilla swap or floating swaps, or simply interest rate swaps, fixed for fixed currency swap, or simply currency swaps. Interest rate swap means where a company agrees to pay a predetermined fixed interest rate on a notional principal for a fixed number of years. And in return, the company will get interest rate at a floating rate on the same notional principal for the same period of time. Let us say I have taken a loan of 10 lakh on fixed interest rate, and another investor takes a loan of 10 lakh at floating interest rate. We can exchange the interest rate if we both agrees. But if the notional principal amount is different, then exchange cannot take place. If I have taken 10 lakh, another fellow has taken 5 lakh, then swap cannot be done because our notional principles are different. And in interest rate swap, the principal is not exchanged. Only the interest rates are exchanged. And at the expiry date, only the differential amount will be paid to the gainer party. Talking about the currency swap, here it includes exchange of principal and interest rate in one currency for the same in another currency. It is also considered to be the foreign exchange transaction. The principal may be exchanged either at the beginning or at the end of the tenure. So these are the two forms of swaps or exchanges: interest rate swap and currency swap. Let us say I have a subsidiary company in UK, and UK fellow is having a subsidiary company in India. So whenever I want to send money to my subsidiary company, then I have to borrow money from the Indian market at a higher rate. Again, I have to send it to the company. Exactly the scenario will be the for UK fellow. UK fellow has to borrow Indian currency from the UK bankers at a higher interest rate. So why to bear higher interest rate payments or higher transaction cost? So what can be done? It can be done. I will borrow Indian rupees and I will pay to the UK subsidiary company operating in India, and the UK company will borrow money in pound currency and they can pay to my subsidiary company. So it can be done. It is a currency swap. So what we have understood so far, the derivative is a form of financial instrument. It is a contract which reduces the risk between two parties, which have more earning opportunities due to fluctuation, due to the market risk, due to the speculation, due to arbitrage opportunity. So when an investor enters into derivative contract, there are different forms of derivative contract. We are trading a fund of future and option in Zerodha Kite, in Grow, in different forms of applications are available. But when we are talking about commodity derivatives, this is a purely different context that I have not covered in this chapter. So when we are anticipating that the price or future price may increase, or the investor will get benefit by betting the future price. If I'm betting a correct price, if I'm betting that the prices may increase in the future, then I can book profits. Or I can bet the price may decrease in the future, then I can book profits. Or if my betting is not favorable, then I have to bear loss. Or some of the investors can leverage the derivative contract. Means by using their ideas, their knowledge, they can get benefit from the derivatives. A small change in underlying assets price will lead to a large change in the derivatives price. So derivatives are more favorable for the traders, for the investors, for the speculators, for the hedgers. So if you are a risk averse, then you can enter into the derivative contract to provide insurance to your portfolios. If you are ready to earn more and more profit, then you can also into a derivative contract. You can use your knowledge, use your expertise to have more and more profits in the derivative market. But as an investor, we should enter into the contract or a derivative contract in order to cover up our risk. And apart from financial derivatives, there are also commodity derivatives like energy, like pulses, like orange juice. There are various kinds of commodities which are also traded in the market. In commodity derivative, we have to open an account with our brokers, and it can be done in the National Stock Exchange platform. I hope you all can understand the concept behind the derivative contracts, why the investors are preferring future and option the market. We are trading in future and option through different platforms. We can deposit, we can make limits, we can have stop loss order, we can have earn 5 to 1,000 rupees on daily basis. People are doing, students are doing also. What matter is to understand the dynamics of operationalization of derivative contracts. You have not understood the concept of derivative, then it is not wise to enter into the F&O segment because it is very highly volatile and highly risky. So first, you should understand the concept of derivative, and then you should practice, you should understand the terminologies used in the contracts. How can you get benefit out of that? Address those situations. I hope this class is useful for us, students, teachers, researchers can get some key points out of that. Thank you.